Okay, up next, we have Pat Goepel, CEO of Assure Software.
Good morning. So I am between you and lunch. So I'll be about 15, 20 minutes, and I'll allow about 10 minutes of questions. If you have a burning desire, burning question, feel free to just speak up. Assure Software, how many have heard of Assure Software before today? Couple? Okay. Well, last time I did that, I think we had one, so we doubled our coverage, right? So anyway, Assure Software, we're on the NASDAQ, ASUR, ticker on the stock exchange. I've been CEO and board member and investor in Assure for about 2.5 years. Our company profile, we're an industry leader in providing cloud-based workplace management solutions. We have a little over 3,000 clients that deploy our services today, and we're starting to grow. We did 2 acquisitions in the fourth quarter, and we're on a organic growth hunt as well as acquisition growth hunt. Our corporate mission is to deliver innovative technology with the passion really to empower every client's workplace and a commitment to make each workday easier. So we do meeting room scheduling, and we do time and labor management. So if you think of physically the old days you punched in a clock, we're an electronic clock where we feed the labor hours into payroll. So somebody like Sun-Maid Raisins will be out in the field picking raisins. They'll use our biometric clocks in order to punch in and make sure they're working, and they get paid a fair day's work. Also, we have somebody at a tech firm that will log into a PC their hours, and they may work 50% at a time for IBM and 50% at a time for another company. We're able to split those hours, call out those hours on the financial reports, and allow the accountants to bill the revenue into different areas, whether it's department labor scheduling or company level scheduling. Meeting room manager books and schedules the rooms. So let's say you're somebody like McDonald's and you have Hamburger University, which is a client of ours. What they will do is, if they bring in 17 franchisees for a meeting, they want to make sure they have the right AV equipment, the right speakers, the right catering in order for lunches, and they want to keep a cost of that meeting room so then they can bill back the franchisees for that cost. So we do the scheduling of meeting rooms and the scheduling of people. Our value proposition, we're in the cloud. So what I mean by the cloud is the client does not have to install any kind of software on site. It is hosted by us. What they have to do is just use our software. And the cloud, as we're going to see in the future, we think we're catching the wave before the wave is really hit, and we think our growth rates are going to go through the roof based on cloud-based adoption. Lower deployment costs, we can get a client up and running within 30 days, so it's quick, and high end user adoption. Everybody uses our software or thereabouts when they adopt our software, whether they schedule meetings or they allocate their time. So this slide is crowded for a reason. This is the full marketplace of time and labor management. You have a lot of indirect competition or direct competition. So payroll companies, ADP, we might be a competitor on time and labor management. We also might get a call from an ADP rep saying, hey, our system doesn't really do this. Can you help us do it? So it's a very unique ecosystem. It's a huge marketplace. Kronos, right smack and dab in the middle, is about $1 billion company. And so now as an investor, you might say, hey, why do I want to invest in a small company in a very crowded market? Well, the next slide really focuses that mid-sized customers, nobody's there. And cloud-based adoption, nobody's really there. So what we feel like is we have the right product with the right technology in the right space at the right time. And And on the small end, we have some players. On the large end, we have some players. And it's very difficult for the large players to come into the middle market. The complexity and the cost complexity curve makes it very difficult for them to do. We think we've tailored the right kind of strategy, and we're going to grow the middle market both organically as well as via acquisition. In the meeting management space, same kind of deal. Not as crowded, not as big, but there's a number of different players. But there again, not a lot of people are in the middle market, and not a lot of people are with a cloud strategy. So we think this is a $100 million market just in itself. We have the opportunity to grow, and we're really excited about it both organically, and we think that there's some acquisition targets. So, step back, meeting room manager, we're in a space, $100 million market potential, no clear leader. We are somewhere around $7 million of repetitive revenue today. We think we can grow quickly, and we're the only publicly traded solution in that market. In time and attendance, part of a huge market, not a lot of people in the middle market space, not a lot of people with our technology, and we think we can grow very quickly to capture more to $300 million space. We did 2 acquisitions in the fourth quarter that were roughly about $6 million of revenue, and we've integrated them into the business, so we feel really good about that. Our history today, when I took over in late '09, Assure was $10 million, losing $10 million. It was an ugly story. We were probably between 10 and 25 cents a share. NASDAQ listing was compromised. There was just a lot of ugliness. We bought in the management, the board of directors. We bought about 30% of the company. We ran on behalf of all the shareholders. We were voted in because of the company's poor performance. I took over, and the management and team and employees, we refocused the business to the business we're talking about today. What we did that first year was largely get profitable, excluding some one-time items on $10 million in revenue. We expanded the sales and marketing in 2011. We had a little over $3 million of free cash flow in 2011. We finished the year about $11 million in revenue. We made 84% reoccurring revenue, so we fixed the business. We did the 2 acquisitions in the fourth quarter. In 2012, we're $18 million in revenue is what we're forecasting, $4 million in EBITDA. We have some one-times with the acquisitions, and $3 million of cash flow. And we're on the hunt to grow again via acquisition as well as organically. So we think we have a pretty good track record, pretty good story. This is more detailed progress. I'd be happy to answer any questions offline or later on. But here, a couple things to point out. Fourth quarter, we exited $3.7 million in revenue. The guidance is for $18 million in 2012. Cash flow is very strong, and reoccurring revenue, when we first started, was 70%. It's now 84%. So that has masked some of the growth rate, because once you put more reoccurring revenue, it sets you up for the future. Deferred revenue has been up about 37%, and cloud-based bookings have been up close to 100% in the last quarter. So we feel really good about the future potential of the business. Our clients are very well known. We have vertical markets where the clients are. You can see by the names: legal, healthcare, education, corporate markets. To date, we have 88% in the U.S., but we're also starting to expand. We have a reseller in the Asia area, and then in Europe, we're starting to get some traction as well, and very, very strong client names. We did acquire ADI in the fourth quarter, and one of the reasons we did is now we have a vertical opportunity with a time and labor solution that really touches almost every client. So the advantage to us is when somebody brings us in and they have a big sales force, it doesn't almost matter what they sell. We can serve them or give them a time and labor management system for their clients. So that has made us very partner friendly. We have an internal sales force based on internet and telephone sales. we also partner with feet on the street. And when we get and tap into and get leads from companies that have 150 or 200 feet on the street, you can grow much faster. So we have about 18 partners today, and we're growing both indirect as well as direct. I talked a little bit about the cloud, and people hear the cloud, but one of the reasons I want, this is the results, the execution track record, and hopefully you see by now that we're really focused on execution. And I always say, strategy without execution is hallucination. And the 60s are over, probably 50 years ago. So I do, hopefully we've shown that we demonstrated execution, but what I want to show you is where we think the next 3 to 5 years that we're riding a wave. Cloud computing, you've heard about it, Salesforce.com, Workday, there's some big names. But I think what everybody's excited about is right now, if you see, people are considering the cloud, evaluating the cloud, planning for the cloud, but they haven't, even today, implemented as much on the cloud. And the market growth is still huge, and we've aligned ourselves. So our competitors are not quite yet at the cloud, but the market is clamoring for cloud-based solutions. And when you look at where we are, and we usually sell to finance people or logistics people or service companies, our cloud adoption is only 8–10%. So 90% of the market is coming. And HR functions, 13%. But when you look over the next 4 or 5 years, or even by 2019, there's billions of dollars going to be spent. So we think we've done the right build out, the right place, the right time. We've gotten our execution model, and now we're really going to go for growth. And that's where strategically we think we've been positioning the company quite well. Like I said, in 2009, we were about 20 cents a share. We did a reverse split to go to about $2. We're now trading somewhere around $7. We're doing a 3-for-2 split to get a little bit more liquid. One of the things that I haven't talked about, we do have a net operating losses. When I first came, we have about $150 million of net operating losses. What that means to an investor is for the next 15 years or so, as we have EPS positive results, we don't pay taxes. And so I think that's also a tremendous positioning as well. The other thing I just want to make sure, I live this every day. 10% owner of the stock. Our board and management is invested in the stock. 2 years ago, I didn't do these road shows. We were really focused on fixing the business. Now we're starting to grow. We're starting to, do acquisitions. And about 6 months to a year ago, I started doing some of these shows. We think we're poised for growth in the future. And that's really it. So that's our story. We're sticking to it. And what questions do you have? Yes?
What kind of growth do you get without you don't make your acquisition target?
We think we should be somewhere around 20 and 20. So 20% growth with 20% EBITDA. That's what we think we should be organically. Yes?
You have no net profit.
What's that?
You have no net profit.
No, I'm sorry.
There are no net profits.
EPS guidance will be given in May. We will be positive this year. What we are going through is a stock split, and we're going through that, but we'll give EPS guidance in April for the first quarter results and for the year. And I don't want to give a specific range, but we will be profitable. Yes? Yeah, I think from a security perspective, there's no question that people are worried about security. That being said, cloud-based solutions have come a long way. We have some pretty, people are taking action. We think we're early in the wave, but we have companies like FedEx or McDonald's on our servers today that are cloud-based. And, what we have looked at is gotten some of those clients as early adopters, and they put us through the paces. Their corporate security have put us through the paces, and we have passed. The other thing is we have sensitive data, but we don't have, for example, Social Security numbers. We don't have financial data. So we do take security very seriously. We co-locate our systems with Savvis. We go through IT department security and very rigorous tests that we've had to do to acquire clients. But I think as people get more and more comfortable with the cloud, I think you'll see security go a long way. And security has not been an issue in our cloud-based adoption to date. They do cover it, and we've had to spend some time looking at it, but as far as customer adoption, I don't think anybody has stopped short of going to our service because of security. Yes?
I believe you said you have 150 million in operating losses.
Correct.
You've inherited. It's just like 15 years you wouldn't be paying taxes. But, I guess that assumes that you'd be earning about, what, 10 million a year times 15 years in order to take advantage of that?
Yep, and we might not get there. I mean, it's a constant battle of building a great business, but also taking advantage of those losses.
Now, this is Redshift Stable 10 research report.
Yeah.
And I'm looking, and they have it by quarter for the last 2 years, and then the full year, fiscal year 11, I assume it's a December calendar year. They have pre-tax income or loss of approximately $600,000, I guess. 603,577 so far. Was that a special charge because of one of your acquisitions? Because it doesn't show any losses for the first 3 quarters, I believe.
Yeah, no, it's a,
Actually, the first quarter is minus 51, but second and third are plus 30, 38.
yeah, it was a non-cash charge, and it had to do with financing. So what we had is, when we financed the acquisitions, we gave people an option to do a convertible, the stock price was $3. They had a $5 convert feature. They also, in effect, it was an accounting, it was a derivative accounting. When the stock price, our stock price went from something like $3 to $8, what happened is we had to capture that run-up in value of the stock. So then when we converted the bondholders, we had to take a charge of about $600K or so to reflect the stock run-up. It was a high-class problem. It was a non-cash charge. It was a one-time charge, and we don't have that problem going forward because the bondholders converted into stock, and we don't have to account for it that way.
Are you talking about the convertible that was converted in March of
Correct.
this year?
Correct.
Even though that happened in fiscal 2012, you reflected it last year?
The run-up in the stock price, we'll have another small charge in the first quarter as a result of that, and I can refer you to my 8K. But what we did is we had to reflect the run-up in the fourth quarter of the stock price from $3 to $6.80, and then we had to reflect $6.80 to, $8, I think, is when we converted it. So those were 2 one-time charges that were just the value of the stock, and then there was no cash charge associated with it.
And those acquisitions closed in 11, right?
They closed October and December of 11.
Because it shows taxes paid last year of $72,000. Added to the 577 pre-tax loss, that gives you 649 net loss for the year.
Yeah.
I'm just curious why you have a negative 72, because if you had losses, why would you be?
There's some alternative minimum tax stuff like that, but it's not, it's not very material overall, but that's what it was. What other questions? Yes?
It seems like the price of your stock is very high. I guess the investors believe you're going to really turn this around, whether it be a combination organically as well as acquisitions. Your price-earnings ratio is pretty high, right? At 6, 7?
Yeah, I mean, hopefully my presentation didn't leave you that the price is high. I think, I showed you the growth potential. I showed you everything. I think the turnaround has been, frankly, we've been told is pretty impressive. So it's all relative on how you look at it.
I guess a lot of it's probably predicated on your increase in revenues. It's kind of a
Well, we did, we did 3.2 million in cash flow last year. So I think, the savvy investor looks at that cash flow, looks at the potential of the acquisition, looks at our execution track record since we started, the fact that we're invested in the stock, and, they got to make a bet. And for some investors, it's a bet they're willing to make, and some, they might not. But
And the 3 for 2 is to create more flow.
yeah, we had 3 million, a little over 3 million outstanding. We've been told, frankly, by some of the stockbrokers, 10 million is a great number. We, with the convertibles, we're about 5 million in the first week here in May, and it was a move. It was a move to signal that we're sensitive, that we're going to create more float. We also think we have some other acquisition opportunities coming, and just you guys. My background, I worked at Ceridian and Fidelity. I ran billion-dollar divisions. I mean, I'm not in it to run a $10 million company. This is, we think we have a long runway. What else? Well, I'd like to thank you for my time, or for your time today. Lunch is being served eventually, so and I'm available for any one-on-one questions. Thank you.